And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the second full week of December. That's right, the countdown to Christmas just right around the corner. Of course, today's the 9th, 25th, just right there. So again, as I keep warning you, don't postpone getting your stuff ordered. This is just your friendly husband service to remind you that your wife is just, I don't care if your wife, don't even tell me your wife didn't say she wanted anything for Christmas. That doesn't matter. You better get her something anyway. That's right around the corner. And shipping is getting delayed a bit, so just be aware of that. But also, when it comes to the markets, we're now in the two sloppy trading weeks of the year. Mutual fund distributions really kind of go in earnest today and next week. So all those kind of mutual funds are going to start distributing out their gains, interest, dividends, those type of things, portfolio rebalancing. And that's actually kind of an interesting topic right now. The market is up roughly about 28% for the year. Throw on some dividends, you're right around 30% for the year. Bonds are, if you look at the AGG, which is the Barclays kind of bond index, is kind of a global look at U.S. debt. That's up about 3% for the year. So that gap in performance, 30 to 3, has led a lot of portfolio managers to be out of balance. In a 60-40 allocation, stocks are now about 65% of the portfolio, bonds are about 35%. So that's going to require some rebalancing. We touched on that in this weekend's newsletter. So if you haven't been to the Bull Bear Report yet on the website, certainly encourage you to read it. We kind of go through some of the couple of background reasons why we might see a little bit of selling here over the next couple of weeks. There's also some technical issues that we'll talk about here in just a moment when we do Before the Bell. But, that rebalancing, managers are going to have to sell about 5% of their stocks, give or take, and they'll have to buy some bonds going into the end of the year and just get those portfolios rebalanced for the end of year reporting, which is just right around the corner as well. So again, there are some reasons why we may see some pressure on the markets over the next couple of weeks heading into Christmas. And of course, after Christmas, you get that kind of window dressing for the end of the year. So a little bit of a correction here is becoming a little bit more possible. Doesn't mean, now, let me be clear. It doesn't mean that has to happen. We don't have to have a pullback in the market. This market could just rally right into the end of the year. It could, right? There's no way to predict what the market's going to do with any accuracy. But historical tendencies, things that need to happen before the end of the year. Also, just from a retail front, you've got a lot of people having to make RMD distributions, a required minimum distribution. That's potential selling pressure as well. So again, there's just a lot of reasons why we should get a little bit of volatility in the markets here over the next 2 weeks. Again, not guaranteed, but there are some things out there. So, this is, as we've talked about before, this is where you just kind of do a little bit of rebalancing in your portfolio, just, taking risk, kind of, reducing some risk off the table. Tesla, a good example. Since the election, Tesla's up 54%, right? Just a huge spurt in price. Its stock is just extremely overbought here. Take a bit of profit off the table, rebalance that position a bit. We've seen kind of all the mega cap stocks do very well. Amazon's at all-time highs. Microsoft's been recovering nicely. Nvidia's up. So we're just seeing, kind of that flow of money into ETFs driving those largest weighted stock names, higher, and we're just seeing that move into the year end. Speaking of ETFs, one of the things that drives the market, and one of the things that a lot of investors haven't really got their heads wrapped around, is that we have a plethora of ETFs, and we've just gone crazy lately doing single stock levered ETFs, bullish levered ETFs. Investors are just piling money into that. If you take a look at the ratio between levered long ETFs and levered short ETFs, those the short ones are dead. Nobody wants those. Everybody's levered long right now on that ratio. But again, all that money flow coming in to those ETFs feed the underlying stocks. So if Apple and Microsoft and Google and Nvidia and Tesla and those guys are the biggest weighted names in those ETFs, and in most cases they are, those get the most flows of that money. Just to give you a number, as of this weekend, right, this year, over $1 trillion has flown into U.S. ETFs. It's the largest on record. We just have a surge of money going into ETFs. Now, this year, that $1 trillion in ETFs dwarfs the hundreds of millions that we saw going to ETFs in 2021. Remember when everybody's getting checks and had nothing else to do with their money except stick it in the market because everything was closed? Yeah, there's a massive flood of money coming into the markets, over $1 trillion in ETFs alone, not including just talking about individual stock flows, all those type of things. Just a massive amount of money going into equities, and that's why you've had a 30% return year. So again, kind of the thing you have to think about also going into next year is where's the next $1 trillion going to come from? I'm not sure where this trillion came from, right? We didn't have checks going to households. We didn't have the Fed doing QE. We didn't have massive new spending bills being put forth out by Congress. We didn't have any of that. And yet $1 trillion, biggest on record, went into ETFs this year. It's pretty amazing, right? But that's why asset prices just continue to kind of rise higher. Sustainability of that's going to be the real question as we move into next year. But let's talk about the markets here from a technical perspective real quick. Here's what you need to know before the bell this morning. Markets did really well last week, of course, continuing to rise, pushing up to new highs on Friday. A huge deviation now between moving averages, just extremely large. And as we've talked about over the last couple of weeks, with mutual fund distributions coming, portfolio rebalancing, all those type of needs, there's a real risk we're going to get a bit of a correction here. Now, again, we're not going to fill that gap. We're not going to the 200-day moving average, but just these major deviations do set the market up for a corrective action. We're overbought on multiple bases as well. And again, that suggests that you're going to get some type of sell-off here just as we start to see that. So again, as we've always kind of talked about, when you have these bigger extensions, and again, nothing any different here than what we saw just here back early in November. And we got that little bit of a correction right after the election, and then the markets kind of took off. So again, kind of that same idea here, just a bit of a correction to work off some of this overbought condition. The Volatility Index also suggests kind of that same thing potentially. Volatility has dropped back down to 13. We're very low volatility. Everybody's very bullish on the market. Stock options, single stock call options are very bullish right now. Nobody's betting on a crash. Puts are extremely cheap right now. So if you wanted to buy protection for your portfolio, buying some puts here are extremely cheap use of money. But VIX is very low, and we're about to trigger a buy signal on the VIX. If we get a little spike in the VIX to 15, 16, 17, which would be absolutely normal, again, that's not any type of crisis issue. It's just basically a sell-off in the markets. We get a little bit of a pickup. This is that pickup in early November where we saw the market sell off a bit. Volatility picked up. Expect that kind of that same type of action, maybe a push up towards 15, 16 in the Volatility Index. That would kind of equate to a bit of a sell-off in the markets. And again, you just kind of have, that action setting up. Very oversold on relative strength, starting to tick up here, getting very close to a little buy signal that would suggest that we're going to see a little pickup in volatility over the next week or two. And again, that will set us up for that year-end rally in the first 5 days of January, which is that typical portfolio rebalancing, window dressing, getting everything ready for the end of the year reporting, and of course, new money getting put to work in the first 5 days of January. So just be aware that we've got that setup right now, that kind of that perfect storm for a little bit of sloppiness in the market over the next 2 weeks. Nothing major, nothing to worry about, but something just to pay a little bit of attention to for your portfolio. That's what you need to know before the bell this morning. When we'll come back, we've got a lot of stuff to get into about markets, upcoming economic reports. We've got the Fed right around the corner. We'll get into all that this morning right here on The Real Investment Show.
Get daily investment news you can use, delivered to the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, good morning. Welcome back to the show. It's Monday. Wake up, peeps. Got to get to work. Got to do all of our things we need to do. So talking a little bit about markets, and again, there's in the chat this morning, there's some comments. I was talking about kind of how much money is flooded into the markets, and yes, to your point, a lot of that is coming from international. We've had just massive flows of international money, foreign inflows into U.S. stocks. So it's just everybody wants to be in the U.S. market because that's where the growth is. It's where the economic growth is. It's where we have a bit of inflation, and inflation is good, right? Compared to every other country in the world that has deflation right now. Not good. Economic growth here is good. I mean, we're looking at about a 3.2% real GDP growth, according to the Atlanta Fed, for the fourth quarter. So as of now, that's going to change a bit as we get other reports in. But again, there's no reason. Corporate profitability, corporate earnings, all doing great. So no reason right now not to have money invested into the U.S. stock market, right? And again, we're just encapsulating. It's not just U.S. citizens chunking $1 trillion into ETFs. It's the entire world that is throwing money into the U.S. markets. One of the questions got in chat this morning was, do I think a 25 basis point cut has already been factored into the market? Yeah. I wouldn't. The market is fully expecting a 25 basis point cut. What is not factored into the markets right now is a pause. Markets are fairly confident at this moment that a 25 basis point cut will be put into the market. So again, it's already priced in. But again, this is kind of where, that we get this kind of complacency and speculation, and that's where things typically kind of go wrong. I posted this chart in our daily commentary earlier this week, and I reposted it in our newsletter this weekend. So if you haven't read the Bull Bear report yet, it's out on the website right now. But I just pulled a chart of the markets just to, just kind of looking at where we are currently in the market versus where we were in 2021. And just lots of very similar themes. And you'll remember we were here on the show talking, back in 2021 about just this massive flood of money. It had nowhere to go but the markets, and everybody was speculating and gambling in the market. So We couldn't get IPOs out fast enough. We couldn't get SPACs out fast enough. We just could not get investments out to people fast enough. So we came to market with things like Peloton and all these other stocks that all of a sudden they're the new thing, and everybody's running these things up, hundreds of percents. And then, of course, when 2022 came along and reality kind of hit the earnings market, though a lot of those stocks lost 60, 70, 80%. But you remember we were talking about Cathie Woods, and she was the darling of Wall Street for about 5 minutes. And she was getting all these inflows, just record inflows into ARK as people were chasing these disruptive, stocks. It was just all about speculation, right? And people didn't care what it was. And as is always the case, when you're doing that, Wall Street goes, oh, they'll buy anything. Let's give them anything. And let's get all this crap off our books and get this out to the market. And so that's what happened, right? And then in 2022, kind of the wheels came off the cart. And here we are again. It's just very fascinating. Back in 2021, I'd go onto my Twitter account and everybody's got laser eyes for Bitcoin on my Twitter feed. And they went away in 2022. They were gone. Now they're all back again. And we're seeing a lot of the similar type of, investment runs. And, as I talked about with Michael last week, one of the things this time, and I got some emails talking about, well, margin debt's not surging, right? Well, I don't have to use margin debt anymore because I have all these single stock levered ETFs that we didn't have before. I have all these levered ETFs that we didn't have before. I can margin without margining. And it doesn't mean that we don't have a lot of leverage in the market, because we do. It's just in a different form that we don't measure as much. We don't really have our hands around it. But the leverage is definitely there, whether it's in levered ETFs, whether it's in speculative call options, 0-day options, etc. But we're seeing that same speculative fervor. And now, it doesn't mean that the markets are going to crash tomorrow. We didn't have a crash in 2022, right? We reversed a tremendous amount of that speculative fervor in 2022, and the market was only down like 19%. So you don't have to have a major crash, right? But we are kind of getting to that point to where we're going to have some reversal that investors aren't expecting, because they're just simply taking on too much risk because they're overconfident. And overconfidence always leads to that unexpected event that kind of pulls the rug out from underneath investors. So, what it is, what will cause that, I have no idea. But I think it's something that we have going into 2025 is something we definitely need to pay attention to. Again, it could be 2026, right? But this is always a challenge of the market. And this is, I'm going to debate Michael Pinto on Zero Hedge on Friday. And he's like, a 50% crash is coming, and so they're trying to find somebody to debate him. I said, sure, I'll debate him. I don't disagree with his points at all. The problem with forecasting is that we've seen a lot of these over the last 3 years, right? The market's going to crash. Everything's coming apart. We're going to be in a massive recession, blah, blah, blah. And the market's been up over 20% for the last 2 years, both years. And so the problem with predictions, and this is why I'm always so careful with you on the show here, is saying, look, I think we've got some risk here over the next 2 weeks because of portfolio rebalancing. We're overbought, we're stretched. We've kind of got all the ingredients for a little bit of a pullback here before the end of the year. Predictions, and this is the problem I have with a lot of people on YouTube, is they come out, it's like, oh, the world's going to end, and the housing market's going to crash. Right? The commercial real estate market is going to crash. We heard that for the last couple of years. Hasn't happened yet. And so the problem with that is that it gets people, they go, okay, well, so-and-so said a crash is coming, so I'm just going to get out of the market and I'm just going to hang out and wait till the crash occurs. And then I'll get back in, which leads to really bad outcomes. Predictions need to be precise. right? The market's going to, this whatever this market is, right? So market, stocks, real estate, whatever it is, it needs to be precise. The stock market in this area, mega cap stocks, are going to crash. So it needs to be precise. What is going to crash? You just can't say the whole world is going to crash, because the whole world's not going to crash. Be precise. Stocks are going to crash. The housing market's going to crash. Be precise. Second thing it's got to have is it's got to be actionable. The market's going to crash, and to hedge against that, you're going to short S&P 500 companies. And it has to be time frame specific. The stock market is going to crash. It's got to be actionable. So I'm going to short the S&P 500 in the last half of 2025. And by having it be precise, actionable, and being time frame specific, investors now have a time frame to work around. And if it doesn't happen within that time frame, then I've got to immediately begin to reassess what changed. And say, okay, that prediction was wrong. I now need to get myself back on the bandwagon of what the markets are doing. But this is the problem I have with a lot of these forecasts. Like, the stock market's going to crash. Great. When? Right? They never tell you when. They'll give you the precise, the stock market. The action is like, oh yeah, I'm short stocks. Great. But when's this is going to happen? And then they keep just kind of rerunning the same the same message over and over and over again for 2 years. And eventually the market will crash, and then they'll go, okay, yeah, I was right. But how much damage did you do to individuals over that time frame? Because if 2 years ago you said the market's going to crash, the markets are up 40% since then. Even if, and here's just kind of putting a fine point to this, right? If the market crashed today by 50%, you would only be back to where we were in 2020. So if you've been out since 2020 because everybody told you that the market was going to crash, great, the market's going to come back to you and you get to start all over again from that point. But, this is the problem with these forecasts. And so we have to be very specific. And this is why I'm very careful with you here on the show saying, look, I don't know when these things are going to happen. I do know there's some risk sitting out there. And I can see it. I can measure that risk. I can see that risk. And I know it will have a consequence at some point. But if I can't tell you when with some degree of certainty, then I'm not going to tell you that. Right? We can see risk in the markets. What we can't see is when that sentiment shift occurs or that exogenous event that immediately shifts sentiment occurs. So we have to be specific. And that's why when we talk about things here on the show, we're always very short term. Over the next 2 weeks, over the next week, over the next few days. Because that's things that we can see, we can be precise about, we can be actionable on, and again, take small measured steps. All right, quick break. We'll come back. I have some other stuff to get into. We'll get into that right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January February 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today. Register today.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Over the weekend, my wife wants to string some lights along the back porch for Christmas. And so I go, hey, you know what? I'll get my son to do this.
The Real Investment Show podcast.
So I said, here, take these strands out there. You and my daughter's boyfriend, y'all go out there and string these lights for them.
Same show, your schedule.
And as soon as they get out there, they unstring the lights. My son steps on 3 of the bulbs, breaks the bulbs. We don't have any replacement bulbs for them. So we have no lights now.
At realinvestmentadvice.com.
We don't get our kids to do things. We do them ourselves because we want them done.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So there was an interesting comment as I was talking about in the last segment about market crashes, and there's a lot of doom and gloomers running around on the internet talking about market crashes, and it gets views, it gets clicks, right? People love that stuff. I mean, if you ever notice the kind of the most viewed videos are the ones that are the most bearish, right? Because everybody just has this. It's like, we that's why we want to watch train crashes, right? We love to watch the wrecks. What people don't realize is that you shouldn't be rooting for a crash, right? I mean, it's not a good thing. It's not good economically. You're going to lose your job. You're going to lose income, lose wealth. We shouldn't be rooting for those things. If I had my way, I would mandate a 20% correction, every other year, just to keep the froth out of the markets, right? But we can't do that, obviously. But we do have booms and busts. And here's the interesting thing about this. If we have a 50% correction, well, let me rephrase that. If we have a 50% decline in the markets, now you would immediately think, oh, that's a crash, right? No, it's actually, in this case, it wouldn't even be a bear market. It would be a correction back to the bullish trend, because this is how far elevated stocks have gotten since 2009. So if you want to have a real bear market, you're going to be talking about something in the neighborhood of 60, 70, 80%, right? And nobody wants that. right? Nobody wants that. People talk about it, but nobody wants that to really happen because that is not a good thing. But again, we've pushed markets to a degree, and we've deviated markets from long-term means so much that now a 20% correction is just kind of a little drop in the bucket, kind of like we saw in 2022. And it doesn't change the bullish trend of the market. It doesn't change the narrative. 30 or 40%, you're going to certainly start getting people's attention, but you're still not going to violate that bullish trend. So one of the problems that we've gotten ourselves into, and in particular with injecting trillions of dollars into, the financial markets, the economy, et cetera, is that we have now deviated markets from economic realities to a large degree. And that's something that eventually we're going to have to get back into. And, we'll have to reverse that at some point. And that's going to be a very long, drawn out process. It's not going to be a 2008 type event where the market just drops 50% and, you kind of reset the table. That's just, we're no longer have that capability. So it'll be something where we go through a long period of just grinding sideways as the market kind of resets itself over time. And that's going to be that's going to be a very different investing environment to be in. And again, how that happens, what causes it, when does it occur, you can't forecast that. To think about, a lot of people have put out there is like, oh, we're going to have, the next Great Depression's right around the corner. The Depression was very specific as to what happened. And there were a lot of things. It wasn't just a financial collapse that caused the Depression. There was this massive dust bowl in the Midwest that wiped out cattle herds. You couldn't live in the Midwest. There was no food. You couldn't grow crops. It was a combination of events that occurred that caused the Depression. But a big chunk of that, though, was that when banks failed, because banks were issuing IPOs, they were loaning the money to their customers to buy the IPOs they were issuing. So it was one big integrated loop. And this is why we separated banks and Wall Street from each other post the Depression. And then we decided to stick them back together in the late 90s. But there was too much interdealing between the banks and Wall Street that led to the financial collapse, and there was no FDIC insurance. So when the bank went under, people lost everything. Today, if JP Morgan failed, JP Morgan's a huge bank. It's probably 20% of the entire banking system all by itself. I don't know the exact percentages, but it's a lot. If JP Morgan went bust tomorrow, it would panic the markets. But investors wouldn't lose their money. Or I shouldn't say investors. Depositors wouldn't lose their money. They would still have the money in their bank account. It's FDIC insured up to certain levels. But what would happen is that the next morning, the Federal Reserve would say, okay, all JP Morgan customers are now Bank of America customers. And all those accounts would just get taken over. And so that risk of massive losses of customer money is not present today. They learned that lesson after the Depression. So we don't have that type of risk. Now, are there other risks that could lead to a massive depression in the U.S. economy? Yes, but you're talking about something that we really can't fathom. So you're talking about massive bank failures. So now JP Morgan, Wells Fargo, all go bankrupt, right? Again, depositors will still be okay. Mid-sized regional banks, wherever, all those assets will get redistributed. But it would certainly cause economic upheaval. You'd have a freezing of the credit markets, very akin to what we saw in the financial crisis. But you're going to need some type of catalyst or some type of event that really shakes the faith of the entire U.S. financial system, not just domestically, but globally. We got a taste of that with Lehman, and they'll never do that again. Of course, now we have a new playbook as well. The Fed would step in with quantitative easing, and the governments would intervene, sending checks to households. We've done all this before. We've seen it. We know what the new playbook is. So it's hard to really get to the point of where, okay, how do we wind up in another depression? I'm not saying it can't happen, but the odds are pretty low. Could we have a financial upheaval in the markets that cause people to lose a lot of money? Absolutely. 20, 30, 40% decline, not out of the question at all. You still need an event. You still need a catalyst. You need something that shakes the faith of the investing public all at once. And all of a sudden, all of the expectations for earnings growth, economic growth, those type of things, they immediately shift overnight. I thought we were going to grow earnings. Right now, estimates for 2025 is that earnings will grow by 19%. Put that in perspective, in 2023, everybody thought that earnings would grow by 15% in 2024. It turned out to be 9%. But everybody expects right now 19% earnings growth next year for S&P 500 companies. It's a big number. On average, earnings grow around 7% a year, 7.5. So 19% is a big number. So tomorrow something occurs. There's some event, some headline, some issue, and all of a sudden people go, okay, we're not going to get 19% growth in earnings next year. It may be 0 because of this event. All of a sudden, all that sentiment, all that bullish sentiment, all those bullish expectations stop and completely reverse. That's how you get a 10, 15, 20% correction on fairly short order. Because you've got to upend those expectations. And right now, there's nothing out there to do that. Expectations are very bullish going into next year. So again, as we start talking about 2025, and we're going to start spending a bit more time on this. I'm writing an article that'll come out in a couple of weeks, right before the end of the year, using valuations as a measure for outcomes next year. And if you take a look at what earnings estimates currently are, they're about $251 a share, right? It's pretty easy to assign multiples. So if we say at $251 a share next year, if we maintain a 22 times multiple, we're going to be at X in terms of the S&P 500. So we can play around with multiples and say, okay, if we get some multiple contraction, if we get multiple expansion, if multiples stay the same, what's my range of outcomes for next year? It's a pretty wide range. So there's certainly some things that can happen. But in order to have that bigger event, you've got to have something that reverses the sentiment. In other words, you need all these really bullish people in the markets to go, I'm out. So you got to think about what that would be. And I don't have that answer. I would love to give you that answer, but we've seen it, and we see it all the time. We saw it in 2022. All of a sudden, everybody's very bullish in 2021. Expectations for 2022 is that the markets were going to keep rising, and then Russia invaded Ukraine. And that was the start of it. And then the Fed starts hiking interest rates and so forth and so on. And all of a sudden, all of those expectations reversed. So what causes it next time? I don't know. But I think you have to be aware of that. And one morning, we're going to wake up and something will have happened and expectations will start to reverse, and then we'll have to take action. I want to come back and finish up with a comment about cycles versus trend. It's an interesting point. We'll talk about that right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
Well, I had some stuff to talk about this morning. I got sidetracked with you guys in the chat, so you're just going to have to live with it. We'll catch up on my other stuff tomorrow. Like I was going to talk about if Santa was a rancher, he'd be a Jolly Rancher, but we didn't get there, right? We didn't get to that quality of topic. So I even have a wife story from this weekend. I'll have to save it for tomorrow. So yeah. Not for her. So, cycles versus trend. So as I was talking about this, and as I was talking about the fact that in order to be of value, a prediction has to be precise, actionable, and time frame specific. And somebody made the comments like, well, you're just kind of talking about trend following. And yes, I am. Because as investors, that's how we should invest, is that if the trend is higher, we should be on the train, right? Not standing in front of the train. It doesn't really work that well. So trend following is very, very important. Now, there's a misnomer with that. So trend following normally is addressed when you're talking about short-term trading. I'm trading a short-term trend in a stock or a market, whatever it is. I'm in, I'm out, I'm in, I'm out, right? So that's typically how trend following is. I'm talking about specific, in this case, we're talking about longer-term trends, right? Are markets generally trending higher? Doesn't mean they're not going to have corrections along the way, but are they generally trending higher? Yes, so I want to be invested. I don't want to be oblivious to the risk, though, which is what we talk about. Cycles are a different issue. So there's 7-year cycles, 20-year cycles, 40-year cycles, and these are talked about all the time in different markets. And yes, if you go back and look at these cycles over time, they tend to play out on a regular basis. It's like, yep, every 40 years, every 20 years, every 10 years, every 7 years. The problem with cycles is, which one do you pick? Is it the 7-year cycle? because that one hasn't really worked out so well. Right? Is it a 20-year cycle? Is it the 40-year cycle? Well, the problem with the 40-year cycle is that that's too long for most people. So, for instance, if I'm, as I was growing up, right, I got my 20, I graduated high school, I went to college, graduated college, got my first job at a bank. I think about what I was making back then. And, I listen to my kids today and they're like, I'm working this job. I'm getting paid, $18 an hour or whatever it is. I'm like, I just kind of, that was like twice what I made coming out of college. But, that was my first job. So I'm trying to pay bills, trying to pay rent, those type of things. And so for most people, if you go back and look at most individuals, right? In your 20s and your 30s, you're just trying to pay bills. You get married. You're trying to buy a house, raise a family, all those type of things. So for most people, they don't really get serious about saving and investing until their mid-40s because they just don't have any money to invest. Now, there's always those few that start early, which is fantastic. I love that for everybody. But for most people, around 40, 45. And I do these events, I do summits, those type of things, and I always take a poll. Like, how many people here are, 5 years from retirement, 10 years from retirement, 15 years from retirement? And by and large, most of the attendees are within 5 to 10 years of retirement. Because that's where they've now gotten to the point that they have money to invest, they've got money put into the markets. So let's just say that by the time I'm 40, 45, I'm now serious about the markets. Well, the problem with the 40-year cycle is that the other end of that cycle is I'm 85 and I may be dead. So cycles need to be somewhat within the contextual time frame of your particular life cycle. The other problem with cycles is psychology, and this is the most important point about cycles. Now, again, nothing I'm saying here invalidates the value of a cycle and understanding how cycles work. I'm not poo-pooing cycles at all. So don't misunderstand what I'm saying. Cycles are, there's a lot of different types of cycles, and we need to understand them and how they work and what influences those cycles over time. Demographic cycles, all those type of things. The problem with them is that in a lot of, for the average investor, the problem with cycles is that they're so long in nature that they get disregarded. Or it impairs the capital of the person following this particular cycle. Something that's 40 years out, 20 years out, 10 years out, that's a very long time. And so the problem with these cycles is that for individuals, psychologically, the cycle says the market's going to crash within the next 5 years. So I'm just going to be out of the market. And then the market keeps going up every year. Well, it said that the cycle said, well, the market's going to crash in 5 years, but they get out now because they're worried about the market crashing in 5 years. Well, I don't want to be there when it crashes, so I'm going to get out now. And so they stay out of the markets. And then the market's up this year, the market's up next year, and finally go, well, I got to get in. I'm losing out too much money. Well, they get in year 4, and then in year 5, the market crashes, right? So again, this goes back, to the function of we have to invest for the time frame we can control, which is roughly 6 to 12 months. So trend following becomes much more important in that function of keeping our capital invested and working for us while the sun's shining. Now, it's eventually going to rain. We know that. We know that it will eventually rain, and I need to take my capital and go inside the house. But for right now, I want to be in the front yard. So trend following keeps me working when I need to be working with my capital. Cycles can give me a clue as to when to start becoming more risk averse, but you have to match that cycle with what's going on economically. because that's what drives cycles. Or what drives cycles is not just market prices. That's not what drives market prices. It's economics, it's demographics, those type of things. So we have to understand those and understand how to apply them to the markets. So again, cycles are important, but it comes down to time frames. And for most individuals investing, they don't have the mental fortitude to invest on cycles because they're so long in nature. Good example of this, my kids. My 60th birthday is coming up in May. I put a tweet out the other day and my son saw it, talking about the evolution of the alphabet and how we went from the Phoenician alphabet to the current alphabet. And he's like, Dad, you write in Phoenician? I was like, no, son, that's cursive. That's cursive, son. Might as well be Phoenician to you, but that's cursive. I'm not that old. But see, my kids think 60 is just an amazingly old age because they're 20. Right? They can't imagine, they're like, man, when I'm 35, I'm just going to roll it up. Right? I'm going to be so old at 35, I just need to quit. We just don't have the mental ability to grasp very long-term timeframes. This is why young people are like, YOLO, I'm going to live for today. Why worry about save? I'll save tomorrow for retirement. Retirement is so far down the road. I'll save tomorrow. I'll get there, right? But I'll start saving later. I don't need to save right now. And I try to explain to my kids is like every year that you give up not saving, not investing, impairs you financially to a large degree. $2,500 is worth about $50,000 in 30 years. Speculate in the markets and lose $2,500, you're like, it's just $2,500. Compound that money out over time. It's a huge amount of money over a long enough time frame. Time frames are critical. Understanding duration is critical. Understanding cycles are very, very important. But we have to navigate the short term. So yes, to your point in the chat, trend following is very important, but not daily trend following, not day trading trend following. Market trends over time are important. Are we in a bullish trend where prices are rising on a consistent basis? Or are we in a bearish trend where markets are declining on a consistent basis, like 2022? Those are the things we need to navigate. Those are the trends we need to focus on because we can control those trends because they're within the time frames that we can understand. All right. Too much heavy stuff today. I apologize. We'll be back tomorrow. Tomorrow, comedy day. Dead jokes all day during the show tomorrow. All right. Y'all have a great day. Get by the website, realinvestmentadvice.com. Our latest newsletter is out. We're also posting some more kind of easy to understand articles starting today, actually, on our website, talking about investment strategies, portfolio strategies, retirement planning, etc. All those on the website for you, of course, realinvestmentadvice.com.